with direct private placements, they're going to mirror very much like traditional private equity, where there's direct alignment. And in our instance, myself and Boone, my brother and business partner, invest directly in each of our funds. So we have capital that we've invested our own money directly into the fund, no different than any other investor that comes in. And that money, our money that's invested in the fund, is treated the exact same way as every other investor. But then we have the management side. And so you brought up a waterfall. There's a waterfall structure in direct private placements. So we've got our money deployed, but then there's typically, like in our instance, I'll use a broad example, an 80-20 split. Investors have, for simple purposes, 80% ownership of the assets, and then we have 20% ownership of the assets and or distributions. Now that comes after meeting a certain what's called a hurdle rate or preferred rate of return. Now that preferred rate of return is a flat stated rate that each investor is owed before we as the manager get to participate in any of the upside income on the asset. So for simple purposes, I'll lay one out that doesn't have multiple. Our current fund has multiple levels depending on what level you come in and invest at. We've got about 750 investors, and north of 10% of that have well north of $1 million invested with us. And then we've got another roughly 60% has north of $500,000, but less than $1.5 million invested with us. And then the rest are somewhere between 100,000 and $500,000. And so we've set up different classes depending on the size that you come in at. But let's forget about that, and we'll use one class as an example. So what we would typically do is we set up a fund that we're going to bring capital into, and the investor earns an 8% preferred rate of return per year before the waterfall takes effect. And so the way that works out is, let's say, and the preferred return or the hurdle rate has nothing to do with cash flow from an asset. Typically, when we buy an asset that's a value add asset, the first year plus or minus is going to have little to no cash flow because we're, taking bad tenants out, we're increasing rent, we're renovating units, we're going to have some vacancy that we experience during that time. And we've talked about this before where if you revalued the asset within the first 24 months after purchasing it, it's going to have a lower value than what it did when we purchased it. And we utilize that opportunity when we've got investors that are doing our Roth conversion strategy that we talk about. But that being said, let's say we've finished the value add and now we're leasing it back up and we start seeing cash flow. So, you may have zero cash flow year one, you may have 2% in year two, you may have 8% in year three. That has nothing to do with the hurdle rate or the preferred return. The hurdle rate is set and it says, as an operator, I'm buying assets that I know I can meet 8% per year, at least through the exit. And I can beat that so that I can then participate in some sort of profit splits. And so let's say in year one, there was zero cash flow. So an investor is going to accrue their 8% preferred return into year two. At the end of year two, let's say there was 2% cash flow that was distributed to the investors. By the end of year two, they've earned another 8%. So they're owed 16% on their money. And they were just paid in year two, 2%. So now net, they're owed 14% going into year three. And let's say year three paid out 8%. It met the preferred return. Okay, so now they carry in, they're still there at 14% going into year four. Let's say year four was 10% distribution, covered the 8%, and it knocked off an additional 2% that they had carried over. So now going into year five, they're still owed 12% from year one and what's left of year two. And then we sell the asset in year five. When we sell the asset, first money goes to catch up the remaining 12% preferred return that's due. Then we pay back the investor's capital. And then everything that's left over and above that is split 80% to the investor, 20% to us.